Let me tell you about two people I want you to picture clearly. The first one never went to college, drives a used car, lives in a modest house in a mid-sized city, has never read a finance book in his life, never tracked his net worth, never downloaded a budgeting app. At 58, he has $600 in a retirement account, a paid-off home, and zero debt. The second person has an MBA, earns $80,000 a year, read the Wall Street Journal, listens to finance podcasts on her commute, can explain the difference between a Roth and a traditional IRA in her sleep. At 58, she has $47,000 in savings, $34,000 in credit card debt, and genuine anxiety about retirement. Same country, same economy, same rules. And here is the part that should stop you cold. The second person is not making random mistakes. She is not financially illiterate. She is not irresponsible. She is making one specific mistake. The same mistake, repeatedly, for decades. And the brutal irony is that this mistake is almost invisible to smart people because it disguises itself as intelligence. The question I cannot stop thinking about is this: why do educated, high-earning, financially literate people consistently end up in worse financial shape than people who know less than them? I have spent the last 2 years studying this pattern, and today I am going to show you exactly what is happening, because once you see it, you cannot unsee it. And I need you to stay until the end, because the last part of this video is the one that actually changes behavior, not information. Behavior. Let's go. Before I name the mistake, I need to show you why smart people specifically are susceptible to it, because most finance content talks about financial literacy as the solution. Learn more, earn more, know more, and everything works out. But here is what the actual data says. A 2023 study published in the Journal of Financial Economics analyzed the financial decisions of over 70,000 Americans across income and education levels. The finding was striking. Higher financial literacy correlated with better knowledge of financial products, but not with better financial outcomes. In fact, in several categories, higher education correlated with larger debt loads and lower savings rates relative to income. People who knew more made worse decisions with money, not because they were stupid, because knowing more gave them confidence, and confidence is the enemy of caution. Here is the specific mechanism. When a financially literate person sees a complex financial product, a variable annuity, a leveraged ETF, a structured note, they do not walk away confused. They walk toward it because they think they understand it. They run the numbers. They build a spreadsheet. They convince themselves they have an edge. The person without the MBA looks at the same product and says, "I don't understand this, I'll skip it." And that person wins. Daniel Kahneman, the Nobel Prize winning psychologist who spent his career studying human judgment, called this the illusion of understanding. The more we know about a subject, the more we believe we can predict outcomes in that subject, even when the evidence says we cannot. Smart people are not protected from this illusion. They are uniquely vulnerable to it. But the illusion of understanding is not the mistake itself. It is the door the mistake walks through. Here is the mistake. The one money mistake smart people keep making over and over, decade after decade, is choosing to optimize their financial decisions instead of automating them. Let me make this concrete. Meet Sarah. She is composite of a pattern I see constantly. Sarah earns $40,000 a year. She knows exactly what a Roth IRA is. She knows index funds beat active management. She knows she should have 6 months of emergency savings. She knows the 401k match is free money. She knows all of it. But every month, instead of automating her savings, Sarah manages her money manually. She transfers what is left over at the end of the month to savings. She reviews her portfolio quarterly and thinks about rebalancing. She researches which high-yield savings account has the best rate before moving money. She waits for a market dip before adding to her index fund. Each of these individual decisions sounds intelligent, and it is intelligent in isolation. The problem is that manual financial management creates decision points, and decision points create friction, and friction creates delay, and delay in personal finance is fatal. Here is what actually happens to Sarah's money each month. Life intervenes. The transfer she planned gets delayed because an unexpected expense hits. The portfolio review gets pushed because work got crazy. The high-yield savings research takes 3 weeks because she wants to make the optimal choice. The market dip she is waiting for either does not come or comes, and she freezes because now she is not sure if it has bottomed. Meanwhile, her colleague Nick, who knows maybe 1/10 of what Sarah knows about personal finance, set up automatic transfers 5 years ago and has never touched them. Nick has $340,000 in retirement accounts. Sarah has $89,000, same income for 8 years. The knowledge gap is enormous. The outcome gap is the opposite of what you would expect. Now here is the number that should permanently change how you think about this. Vanguard's most recent data on automatic versus manual investors found that investors who set up automatic contributions and left them alone earned, on average, 1.5 to 2 percentage points more per year than investors who manage contributions manually, not because of better investment selection, but because automatic investors stayed invested through market downturns, while manual investors paused contributions or pulled money out during volatility. 1.5 to 2 percentage points per year sounds small. Over 30 years at 7% versus 5% on the same $50,000 monthly contribution, the automated investor ends up with $50,067. The manual investor ends up with $40,018. The same money, the same fund, the same person. $49,000 difference from one decision made once versus the same decision made imperfectly month after month for 30 years. That is the cost of optimization over automation. Here is the part that most finance content skips, because most finance content is designed to sell you information, and information is the enemy of the actual fix. Smart people choose optimization over automation for 3 specific reasons, and all 3 feel like virtues. Reason 1. The illusion of control. Smart people genuinely believe that their active management adds value. If they just find the right allocation, the right timing, the right fund, they will outperform the automatic approach. The data does not support this. Spiva, which tracks the performance of active versus passive investment strategies, published its 2025 report showing that over a 20-year period, 94% of actively managed US equity funds underperformed their benchmark index. 94%. These are professional fund managers with research teams, Bloomberg terminals, and decades of experience. If 94% of professionals cannot beat the index consistently, the smart amateur reviewing their portfolio on a Saturday morning cannot either. But the smart amateur does not believe this applies to them. The MBA feels like an edge. The spreadsheet feels like an edge. The research feels like an edge. It is not an edge. It is friction with extra steps. Reason 2. Perfectionism as procrastination. Smart people want to make the optimal choice before they act. Which high-yield savings account is best? Which index fund has the lowest expense ratio? What is the ideal asset allocation for their risk tolerance? These are all real questions, and pursuing them feels productive. It feels like responsible financial management. But perfect is the enemy of funded. A person who puts $500 into a slightly suboptimal fund today will dramatically outperform a person who spends 3 months researching the optimal fund before investing. The difference between a 0.04% expense ratio and a 0.08% expense ratio on $10,000 is for a year. The cost of not investing for 3 months while researching is roughly $17.5 in missed market participation at historical averages. Perfectionism costs more than imperfection. Reason 3. The confidence that comes from knowing. This is the deepest one. When you understand how financial markets work, when you can read a balance sheet, model a DFA, explain yield curve inversion, you feel like you should be using that knowledge actively. Automating everything and walking away feels like a waste of your capabilities. It feels like giving up, like intellectual surrender. But here is what the data shows. The Fidelity study that has become almost legendary in behavioral finance found that when they looked at which accounts had the best performance over a decade, the top performers fell into 2 categories: people who had forgotten they had a Fidelity account and people who were dead. The people who knew the least and did the least won. Now I want to show you how this mistake does not just cost money in isolation, it compounds into a pattern that takes over every financial area of a smart person's life. Meet David, composite character, real pattern. At 28, David starts his first real job. He knows about the 41k match. He intends to enroll, but he wants to research the fund options first because some of them look expensive. He will get to it next month. 6 months pass. The market has a good quarter. David decides to wait for a pullback before starting. He will definitely get to it. By 30, David has left $4,200 in employer match on the table. Gone. That $4,200 compounded at 7% for 35 years was worth approximately $4,200 and dollars. He lost $44,000 without making a single bad investment decision. He lost it through delay. At 32, David has some credit card dollars, $8,000 at 22%. He knows he should pay it off aggressively, but he is also thinking about investing because the market looks good. He reads that some people recommend investing instead of paying off debt when expected returns exceed the interest rate. He spends 2 months analyzing whether his expected return justifies carrying the debt. During those 2 months, the $8,000 balance generates $23,000 in interest. Not because David made a wrong decision, because he was busy making the optimal decision. At 35, David inherits $40,000. He knows he should invest it, but the market is near all-time highs and he has read that valuations are stretched. He puts it in a savings account temporarily while he waits for a better entry point. He waits 14 months. The market goes up 19% during that period. His $40,000 missed $7,100 in returns while sitting in an account earning 4%. By 45, David has a good income, strong financial knowledge, and underwhelming financial results. He cannot understand why. He is doing everything right. He is thinking carefully about every decision. He is being smart. He is being smart in exactly the way that costs him money. The mistake is not the individual decisions. It is the system or the absence of one. The fix is not more knowledge. The fix is removing yourself from the decision loop entirely. Here is the exact architecture that eliminates this mistake permanently. And I want to be clear, this is not a simplified version for people who do not want to think. This is the conclusion that the most sophisticated thinking about personal finance reaches. Automate first. Optimize later. Maybe never. Layer 1, the paycheck split. Almost every payroll system in America, ADP, Workday, Paychex, Gusto lets you split your direct deposit across multiple accounts before the money ever hits checking, not transfer after it arrives. Split at the source. This is the single most important financial setup most people never do. You tell her, send 10% to this high-yield savings account, send 6% to my 401k enough to capture the full employer match, and send the rest to checking. From that day forward, the saving happens before your brain knows the money arrived. You cannot spend what you cannot see, and you cannot optimize your way out of a system that does not ask for your input. Layer 2, the investment automation. Open a Roth IRA, Fidelity, Vanguard, or Schwab. All three are excellent. Set up an automatic monthly contribution on the day after your paycheck hits. Buy a total market index fund or an S&P 500 index fund, whichever has the lowest expense ratio available. Set it to automatically reinvest dividends. Done. Do not look at it more than once a year. The expense ratio difference between the major total market funds is approximately 0.01 to 0.03% meaningless. The fund choice matters almost nothing. The automation matters enormously. Pick one and start. Layer 3. The debt autopilot. If you have high-interest debt, anything above 7 or 8%, set up an automatic payment that exceeds the minimum by whatever amount the architecture allows after layers 1 and 2. Not a manual transfer you do when you remember. An automatic payment on a fixed date every month. The minimum payment on a $10,000 credit card balance at 23% is designed to keep you paying for 11 years while generating $13,000 in interest. An automated additional $200 a month kills the same balance in 3 years for $3,400 in interest. The difference is $9,600 and 8 years of your life from one setup decision. Layer 4, the annual review, not monthly. The final layer is the hardest for smart people to accept. Once the architecture is running, once the splits are set, the Roth is funded automatically. The debt is auto-paying. Your job is to review it once a year. Not quarterly, not monthly, once a year. Increase your 401k contribution percentage whenever you get a raise. Half of the raise goes to the automatic split, half goes to lifestyle. That is the only active decision in the system. Everything else runs without you. The hardest part of this for educated people is that it feels like abdication. It feels like you are not using your intelligence. You are using your intelligence. You used it to build a system that does not require your intelligence to function. That is the highest application of financial intelligence, not managing money actively, but designing a structure that wins without management. But what about market timing? What about optimizing asset allocation? What about tax loss harvesting? What about... I hear you, and here is my honest answer. Yes, all of those things have theoretical value. Tax loss harvesting, done correctly, can add maybe 0.5% to annual returns. Optimal asset allocation, rebalanced precisely, might add another 0.2 to 0.3% over time. Now compare that to the 1.5 to 2% annual return drag that comes from manual management, from the delays, the pauses during volatility, the paralysis during market downturns, the 3-month research projects before investing. The optimization you are trying to capture is worth less than the cost of trying to capture it. The math is not close. Automation wins by a margin that makes active optimization look like rounding error. And here is the final thing I will say. The people who built serious wealth on normal incomes, not hedge fund managers, not crypto traders, regular people, almost universally describe the same thing when you ask them how they did it. They say some version of, I set it up, I left it alone, and I stopped thinking about it. That is not a coincidence. That is the pattern. Remember Sarah and Nick from the beginning? Sarah is not less intelligent than Nick. She is not less disciplined. She is not less capable. She just never built the architecture. She kept the decisions in her own hands because she was smart enough to think her decisions would be good ones. Nick built one system on one Saturday afternoon, and then he went and lived his life. The system ran every paycheck, every month, every year, without asking Nick for permission. 10 years later, the gap between them is not a gap in knowledge. It is a gap in what they built and what they left alone. You now know what the mistake is. You know why smart people make it. You know the exact architecture that fixes it. The only question is whether you spend this week optimizing your approach to implementing it, or whether you spend this Saturday actually implementing it. One of those choices is the mistake. The other one is the end of it. If this gave you something real, subscribed. Every week I break down exactly how money actually works for people on normal incomes. No hype, no shortcuts. Just the mechanics. See you next week.